Welcome back to the second half of the Futures Show. Less than 60 minutes away from the cash open for stocks on Wall Street. Still kind of getting mixed signals from the futures here this morning. No real lean one way or the other. Basically unchanged to slightly higher. We have Phil Streible joining us this morning, Chief Market Strategist at Blue Line Futures. Phil, welcome. We just had some numbers coming across the wire. Import-export data, obviously not the most closely watched numbers of the week. Exports coming a little higher than expected. Imports a little bit below what analysts are looking for. But let's begin with what we're seeing in terms of treasuries this week. It appears to be a market that's coming to grips with that higher for longer narrative and a relentless move up here in treasury yields.
Yeah, if you look at the treasury yields, but they've been quite volatile. I mean, we've got a 10 basis point correction going on today. Yesterday, we had 10 basis point of a rally. It's really kind of come unhinged. If you look at, the course of the week, it seems like the geopolitical, tensions, escalations going on over in the Middle East really question whether or not the Federal Reserve can keep on a interest rate hike path. They want to see what the ramifications are from that. I think that if you do see crude oil prices continue to tick up on that, the Federal Reserve is going to I think they're going to surrender and give up on fighting this inflation for the time being and wait till the dust settles over there.
Phil, everybody's been talking about these pullbacks and getting excited about them, right, in terms of the moves off the spikes that we've seen in yields, off the highs. But it seems to be more, for me, a 2 steps forward, 1 step back kind of thing. I mean, pretty well-defined trend to the upside here, still established. And, I mean, you can see this, right, playing out. If you're a home buyer, ultimately, you're feeling it. If you're trying to get an auto loan, you see this, right, on a daily basis. If you hold a credit card balance, ultimately, I mean, it's pretty well-defined here. Yes, we've pulled off the spike high, but I mean, stubbornly elevated levels.
So I'm trying to purchase a second home right now, and the clause that was within the letter, the approval letter, said that interest rates couldn't go higher than, I think it was 7.25%. And this was just drafted a couple weeks. Yeah, it went right above it. Yeah. So if we were to accept if they were to accept the offer, I'd have to get a new letter. So I mean, these are like real things that are impacting people. Absolutely. I couldn't imagine, going out and trying to get like an automobile or having those high credit card debts. So I think the Federal Reserve, I think that they got to take a different approach to things. I think yields and interest rates need to come down substantially. You can't rise that fast without breaking things.
I can't imagine the pinch people are feeling. Adjustable rate mortgages or home equity lines of credit, for example. I mean, it's staggering, I would imagine. Every time you open up that envelope, that bill, when you check in online, I mean, it's got to be higher and higher every month, basically. But the market here hanging in there pretty well, considering, and we've got the S&P set to open up this morning just below 4,400.
Yeah, the S&P, so what's going on right now is that they're not really paying attention to that inflation data that came out. Like when we saw CPI come out yesterday, that was the first time that they had acknowledged, any inflation data all week. They're really focused on these geopolitical risks and tensions rising and thinking that the Federal Reserve can't make any kind of moves. So we saw barely an uptick on expectations for further interest rate hikes. And I think the reality of interest rates coming down, it looks almost certain. So, a lot of the foreign currencies are starting to get a boost. The U.S. dollar is starting to come back. It really needs to break below 105.50 in order to trigger more of a neutral trend. But, you look at some of these moves right now. I mean, gold's up $45. Yeah. Silver's up 73 cents. Yeah. I don't think people want to go home heavily weighted in equities and with these types of events that are occurring overseas.
Yeah, I have a question for you, Phil, in terms of the Fed. I'm wondering if they're a headwind for the market right now or a tailwind. We've been looking at a lot of chop-type price activity, a very consolidated environment, a market that's got a very well-defined upper and lower extreme, and not a lot of conviction right now. Which do you see them as?
Yeah, the Fed, we had a ton of speakers come out this week, and kind of the way that I packaged it together is that they're taking more of a softer approach. They're really saying that they're going to let things kind of settle at these levels. They're not mentioning anything about cuts, but I think that they're they can't just say that they're going to take a breather and let things play out. They do come with that last sentence where, but if we need to raise rates, we'll do it again. But I don't think anybody believes that anymore. It's just, there's just too much pressure going on. I mean, the amount of interest on the debt, on the national debt, is like insane. So, I mean, they just can't do that. These things are going to play out. Where the Fed's supposed to operate independently from politics, I think that is going to clash significantly, especially coming into an election cycle.
Big move up this week, also raising some concerns in terms of some of the regional banks, right? We saw that playing out earlier this year in the spring. And obviously, when we get to 5% in the 30-year, that's going to spark that conversation again. Take a look at the charts here real quick. I just want to point to and provide a couple visuals in terms of the discussion we're having here. A look at what we've seen recently, the 30-year on the left, the 10-year on the right. 5% here, Phil, last week, and the 30-year still held below that this week, but hanging out into the end of the week here, right around 4.8. You can see the 10-year just below 4.9 last week. Look at this run-up that we saw in gold. Best week for gold since March. I think a 7-month best week run here. We're up to 1932. Definitely a reflection of some of that geopolitical tensions, geopolitical uncertainty. Talk to us a little bit about currencies. The U.S. dollar right now still relatively contained, considering at 106, and you've got the yen kind of falling off the radar in some ways. Uncertainty about China and news about some stimulus, but still nothing specific there this week.
Yeah, no, in China, they can't get inflation to save their lives right now. I mean,
you look at some numbers.
It's just terrible. And then, so they've got to come in. They've got to create something going on. The Japanese yen, it got one little safe haven bid on these problems that are going on. But other than that, that currency is just flat. The one to watch is probably the Swiss franc. I think that's the leader today. It's up about 0.5%. Brazilian real just under 1%, and the peso also. So those are some obscure ones that'll impact some of the commodities that are out there. But, you know, we just got to keep an eye on some of these things because these markets are wild.
And with all that playing out here, I just real quickly want to take a look at the U.S. dollar as it has seen a little bit of a rally, but also relatively contained, right? From the week lows we saw around 105.29 back up to 106.40. Taking a quick look at where we are on the daily candle chart here, though, you can see not a lot of real follow-through after a big run-up. The July lows around 99 back to 107, and here we are mostly overlapping rotational and sideways as traders wait for more information. Appreciate you joining us, Phil Streible, this morning. Thanks for sharing part of your Friday with us. Check Phil out at Blue Line Futures. Some chief market strategist there.